LP5 seminar summarizes the concepts in the chapter entitled Using Budgets for Planning and Control and the chapter on Financial Control. We've reached the last learning plan for the course. Our final 2 weeks will be the most challenging. Our topics include the importance of budgeting and how to do it and financial control. Successful completion of this learning plan requires you to understand the relationships among various budgets and the financial statements. You will also need to understand the difference between cash flow and accounting income. First comes long-term plans and goals. Throughout this discussion, do not forget the basics of human behavior in organizations that we have discussed previously. However, in the last 2 chapters of the text, we must deal with numbers. After all, this is a management accounting class. So let's begin with the role of budgets and the budget process from a technical perspective. Long-term planning consists of capital projects that are planned by management and analyzed by capital budget finance models. Hopefully, you've learned these models in your finance class. We're going to focus on the annual budget. The annual budget has a short-term horizon. We begin with the knowledge that our capacity has been determined for the year and that most capacity costs have been committed and will not change with this period's activity. Then, the budget becomes a quantitative model of the entity's operating activities. Managers must be aware that the income statement provided to investors and creditors measure income on an accrual basis that follows U.S. Generally Accepted Accounting Principles, or U.S. GAAP. Cash flows are different from accrual income. Managers must be sure the cash flows and outflows are sufficient to sustain the operations. Budgets are short-term tools. Management must first commit resources to create the capacity of an organization to perform its functions. Once that's done, we can move on to the annual budget. Remember, no one can predict perfectly. Once a budget is prepared, managers should compare expected results to actual results. This happens at the end of an accounting period. Differences between actual results and the budget plan are called variances. Variances are part of a larger control system for monitoring results. Exhibit 10.1 in our text provides an overview of the planning and control system and how annual budgets support the overall goals of a company. Let's look at the process. Chances are, if you've ever worked for a medium or large organization, you've been exposed to the budget process. Hopefully, even smaller businesses have a budget, but not always. Ideally, there's a master budget that consists of both the operating budgets and the financial budgets. Exhibit 10.3 in the text shows the linkages among the different supporting budgets for a manufacturing company. A company must provide the capacity to perform its operations. Your authors identify 3 different capacity levels. So look at Exhibit 10.6, and the next slide describes these 3 levels. These resources determine the level of monthly production capacity. There are flexible resources that the organization can acquire in the short term. For example, materials. There are committed resources that the organization must acquire for the intermediate term, including labor. Committed resources for an organization that must acquire for the long term, and these are the capital items such as plant and equipment. The production plan. Management is able to produce as much as the capacity as they created for a company. Of course, they can always outsource in order to get more capacity. The production plan will be a guide for buying sufficient materials and hiring and training employees to complete the products within the factory. We can't forget the selling or marketing and administrative plans. Most administrative and marketing expenditures are discretionary. They can be classified as a discretionary fixed cost if they are in the short term and they're not dictated by any level of activity. There may also be variable selling and administrative expenses. Let's return to Exhibit 10.3. Are you able to identify all the components of a master budget? The annual budget builds on the stated organization goals, which require a capital budget to create the capacity. Then, theoretically, a sales plan is created. After that, a production plan is created with sufficient detail to budget the required materials to be purchased, the amount of finished goods inventory to be produced, as well as the labor and overhead budgets for the period. Budgets are not financial statements. Companies must prepare financial statements for investors and creditors. Financial reports to investors and creditors must follow U.S. GAAP. Financial statements, remember, consist of an income statement, a balance sheet, and a statement of cash flow. The cash budget can be compared to a statement of cash flow. Look at Exhibit 10.9. It shows a detailed plan for cash inflows and cash flows for the year. This is not the format for investors and creditors. However, it is an important managerial tool and an essential component of the budget process. Problem 1056. This problem requires you to do all the parts of a master budget. First part asks for a number of raw material units to purchase for the period. That's the starting point. So see the worksheet on the next page. Notice that it follows a typical accounting formula. What are the number of units required for sales? What is the desired ending inventory? This information comes from management, who decides whether inventory should be built up or whether it should be reduced. Those sum up to the needs, and then we subtract whatever units are in beginning inventory in order to determine what units need to be purchased for the period. This report is usually prepared in not only units, but the dollars that are needed to acquire the resource. Let's continue with problem 1059. The next part asks you to prepare an income statement. Remember, the income statement is based on the units sold, not produced. So let's see the next slide for a model income statement. The income statement begins with sales minus the cost of goods sold, and that subtotal is the gross margin, sometimes called the gross profit. The gross margin, less selling and administrative expenses, is the general model to determine net income. So I have put in the number of units is 12,000. 12,000 units were sold and sold at $60. The same number, you have to match the number of units. 12,000 units were sold and the accounting cost is $40. Therefore, for every unit sold at 60, that costs the company 40 to produce and sell, is a $20 gross margin. Doesn't matter how many units were actually purchased. What matters is how many was sold. As we conclude problem 1029, the cash flows follow the cash received. In this problem, the customers pay 60% of what they owe in the first month and 40% of the following month. This is typical in a company where a lot of the sales are on credit. On the other hand, our company pays for half of the goods that they used in production during the current month and half the next month. So you can see it's very important that they forecast a cash flow in order to pay their own bills. So let's look at the next slide for a model cash flow report. Pretty simple, isn't it? Cash inflows minus cash outflows is net cash flows. You can add the beginning balance in order to arrive at the ending balance. And so these numbers conform to the problem that are in the text. Next, we need to compare actual results to expected results. Periodically, usually monthly, but could be weekly or quarterly, managers must compare actual performance to expected results. The differences are called variances. In accounting, if sales are less than expected, we say it's unfavorable. And in accounting, if costs are more than expected, we say it's unfavorable. Variances can be favorable or unfavorable. Back to Exhibit 18. This exhibit report sees differences between actual costs incurred during the period and the expected costs. So I ask you, if you were a manager, how would you defend the $4,700,000 unfavorable variance for material? In this case, it's in English pounds, but I couldn't find how to record a pound. To better understand variances, why they occur, we used a concept called flexible budgeting. Flexible budgets are a wonderful tool for managers. Suppose the company generated more sales than expected. Surely the materials cost for production would increase. Managers should not be responsible for additional cost if sales volume increases, that's the cause of the additional cost. Rather, production managers should be responsible for the cost due to production inefficiencies. So now look at Exhibit 1019. It reveals the company would have budgeted $27,500,000 and not $25 million for materials. However, management expected the cost per unit to be $25. It turns out the production costs for materials were actually $27. Thus, the production manager needs to explain why each cost more than $2. And there may be some uncontrollable or controllable factors. For example, if there's a price increase, that's beyond the manager's control. But if it was simply due to waste or inefficiencies, the manager gets this feedback. So here's how to separate differences due to volume compared to differences in cost due to inefficiencies. All you have to do is use a flexible budget. In Exhibit 1019, the flexible budget column is the budget that would have been given to the production manager if the company accurately predicted the actual volume of sales. And here's a completed example. Problem 1067 was not assigned. See if you can follow the next slide that presents the flexible budget. The planning variance is due to volume changes. The flexible budget variance shows whether or not the production manager met the expected per unit cost for materials and overhead. So the example given is that the budgeted materials cost is $630,000 based on 90,000 units or $7 a unit. The budgeted direct labor per unit cost was determined to be $2.75 and budgeted for 90,000 units at a total of $247,500. The budgeted fixed costs equal $420,000. So take a look at the master budget. We have materials, labor, and overhead. And then we have a flexible budget because the actual production was only $80,000. Note the flex is in the variable cost. That is, direct materials should be less if less are produced, and labor costs should be less. It's a variable cost, and less units were produced. But there shouldn't be any variance related to fixed overhead. The $420,000 is going to be incurred for rent and other fixed expenses regardless of the activity level. So the first variance is called the planning variance. That is $97,500 less should be spent for materials and labor because we had 10,000 less units produced. Then we can look at the comparison of the flexible budget, the budget that we would have given management, and compare that to the actual expenses. And we see that for materials, the manager spent $560,000 when an efficient use of resources would have been, an efficient use is $560,000, but the manager actually spent $550,000. So we pat the manager on the back and say the variance is $10,000 favorable. Of course, in reality, the manager might have used inferior goods, and eventually the product may break. So we really have to look deeper into the nature of this favorable variance. But it points our attention to and gives a dollar amount to the variance. On the other hand, direct labor should have been $220,000 for 80,000 units, but the manager spent $225,000. So in this case, that we call that an unfavorable variance because the manager spent more, but once again, it may be interpreted as just an uncontrollable variance. Finally, let's look at the fixed overhead. The budget was $420,000 and we only spent $400,000. So from a budgetary point of view, we spent $20,000 less. Again, we would have to look at and try to explain what happened, why did that go down? So, were you surprised to see the use of cost volume profit analysis in our budgeting chapter? You thought that once you studied it, we didn't have to come back to it. Clearly, cost, volume, profit, and break-even points help managers develop budgets. Remember, however, that the costs in the CVP analysis are only relevant within the relevant range, a point that I made over and over again. When volume changes beyond the relevant range, budget variances become more complex. So we've concluded our summary of Chapter 10, and now's a good time to take a break. Well, welcome back. We're at the end of the chapter and the end of the course. Our course concludes with Chapter 11, Financial Control. Our author states, Chapter 11 begins with a discussion of the environment of financial control and the motivation for decentralization. As decision-making becomes more decentralized, organizations devise ways to motivate managers and reduce as many inconsistencies across divisions as possible. So what's meant by financial control? Your authors state that financial control involves the use of financial measures to assess organization and management performance. Financial control brings all aspects of our course together. Your authors highlight that financial control plays an important role in that plan, do, check, act cycle identified in Chapter 1. Chapter 2 explored the important role of the balanced scorecard, which was a means to quantify and communicate the organization's strategy. In not-for-profit organizations, success is ultimately gauged by various financial metrics. In for-profit organizations. In not-for-profit, financial metrics are important, but certainly the organization wants to accomplish its social mission. Chapters 8 and 9 viewed financial control as part of a broader topic of management accounting and control systems. So, do we know what the difference is between a centralized or decentralized organization? Companies can make decisions from the top down, leaving managers with little discretion to make operating decisions. This happens in centralized organizations. Alternatively, decentralized organizations allow managers greater decision-making abilities. Internal structures impact the way organizational units are budgeted and evaluated. Look at Exhibit 11.2. There are 4 types of responsibility centers: cost, revenue, profit, and investment centers. Each one reflects the level of responsibility of the manager in charge. Cost and revenue centers are more likely in centralized organizations, while profit and investment centers are appropriate for decentralized organizations. As described in the text, a company uses controllability principles to evaluate responsibility centers. Exhibit 11.3 shows how a performance report can be adapted to report the results of a segment. Note that the managers are not responsible for unallocated general costs, but they are responsible for the direct costs associated with their segments. So now we get into the accounting issue of transfer pricing. Organization units often transfer products and services to other units. Transfer prices impact the revenues to the selling division and the costs to the buying division. A transfer price could be the entity's full cost, a negotiated cost, a market-based cost, or a cost imposed by top administration. See Exhibit 11.8 for a summary of the advantages and problems associated with each transfer price. Problem 1170. Problem 1170 asks you to discuss the issues in choosing a transfer price for the Plenva Manufacturing Company. When you answer this question, be sure to include numbers. This is an accounting class. Specify what the transfer price would be under your proposal. And what role does the opportunity cost play for each division? Now we'll talk about investment centers. When a manager is responsible for revenues, costs, and the capital investment needed to run the unit, we refer to this type of responsibility center as an investment center. Many, many years ago, DuPont broke down the components of a traditional return on investment ratio into several components. See the Exhibit 11.9 for all the elements that make up a return on investment calculation. So you reach the end. You've concluded Learning Plan 5. When you've reached this slide, you have completed the seminar. Answer the assessment questions found in the last slide. You should complete the LP5 problem set. Your study should complete the LP5 case study, And remember, there is a final project paper due. The last problem assigned to you for homework is problem 1171. Your authors state this question explores some of the practical problems of using return on investment criterion to evaluate ongoing investment in fixed assets. The return on investment tool was originally designed to evaluate new investments rather than ongoing investments. You might have learned this in your finance class. In the case of new investments, there's no confusion about the investment amount. When this tool is used to evaluate ongoing investments, important valuation problems have to be resolved. So here are the assessment questions. What are the advantages and disadvantages of A, a centralized organization, and B, a decentralized organization? 2, what types of responsibility centers would be appropriate for a centralized organization and B, a decentralized organization? And which of these two types of organizations would you like to work and why? This is the end of our seminar.